Warren Buffett is often called the greatest investor of all time. But here's a shocking fact. In the last 50 years, his company, Berkshire Hathaway, has delivered an average annual return of 20.1%. That's more than 2,700% higher than the S&P 500, including dividends. If you had invested $1,000 with Buffett in 1965, it would be worth $27 million today. How does he do it? Well, Buffett isn't following the latest trends or guessing on hot stocks. Instead, he's mastered a set of timeless rules that anyone can use to buy stocks like a pro. These rules aren't complicated, they're straightforward, focused on patience, and built on solid business fundamentals. The key is his ability to spot opportunities others overlook, then hold on to them for the long term. In this video, we'll break down Warren Buffett's checklist for buying stocks. You'll learn how he picks the right companies, how he avoids market noise, and why his investment strategy has stood the test of time. Whether you're a beginner or an experienced investor, these strategies can help you make smarter choices and build wealth. Stick around to discover the key habits that could make you the next Buffett. Chapter 1. The Foundation of Value. What Buffett sees in a company. Warren Buffett's strategy is rooted in the idea of buying businesses, not just stocks. He looks for companies with a strong foundation that can weather any storm. A solid business model, a loyal customer base, and steady cash flow are key factors in Buffett's checklist. He once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." For Buffett, the company's quality matters more than the immediate price tag. A strong management team is another big priority for him. He likes CEOs who are both capable and trustworthy, qualities that matter more than the company's size or stock price. He's known to invest in businesses where he respects the leaders. And he often makes decisions based on their ability to make smart long-term moves. Buffett focuses on businesses that can grow steadily over time. He doesn't care about flashy trends or quick wins. He sticks to his core belief: a solid foundation guarantees future growth. In fact, a study by Morningstar showed that companies with strong leadership see higher returns over time. Buffett's investment style also reflects his personal philosophy of patience. He looks for companies that can last for decades. This isn't about finding the next hot stock, it's about investing in a business that will remain stable. Buffett's approach reminds us that a great company can ride out any market turbulence. Chapter 2. The Price is Right. How Buffett finds undervalued gems. Buffett's success comes from buying companies at the right price. He has a simple rule: only buy when the stock price is lower than the intrinsic value of the company. Intrinsic value is how much a company is truly worth, based on its future earnings. Buffett explains it this way: price is what you pay, value is what you get. He uses detailed calculations to estimate this value, focusing on a company's earnings and assets. This is a crucial step because the market can often misjudge a company's true worth. For example, Buffett's famous investment in Coca-Cola was based on its future earning potential, not just its current stock price. A study from Vanguard shows that paying too much for a stock can severely limit its long-term returns. Buffett isn't interested in short-term market fluctuations. Instead, he seeks stocks that are undervalued by the market but show great potential. In many cases, he's willing to wait for years for the market to catch up to the company's true value. This is why Buffett's portfolio is filled with companies like American Express and Geico, stocks that are deeply undervalued at times, but have massive long-term potential. Chapter 3. No room for fads. Why Buffett ignores the noise. One of Buffett's golden rules is to ignore market noise. The stock market is full of trends, rumors, and fleeting fads. Buffett, however, doesn't get distracted by these. He's a long-term thinker who focuses on a company's fundamentals rather than short-term speculation. The stock market is filled with individuals who know the price of everything, but the value of nothing, he famously said. Buffett doesn't care if the latest tech trend is causing a stock's price to soar. He sticks to companies that have a proven track record of consistent earnings. This focus on stable growth has been the cornerstone of his investing philosophy. Over time, the market may overreact to news, but the quality of a business doesn't change that quickly. For instance, despite all the hype around tech stocks, Buffett prefers businesses that have weathered decades of challenges, like Coca-Cola and Procter & Gamble. Research by Yale University confirms that chasing market trends often leads to poor returns in the long run. By staying away from fads, Buffett avoids getting caught in short-term market bubbles. This patient approach lets him make smarter investments, avoiding the ups and downs of speculative trading. If you're enjoying this so far, make sure to subscribe to the channel and hit the notification bell, so you never miss out on more insider strategies like these. Chapter 4. The 5-Minute Rule. How Buffett Gauges Company Leadership. Buffett places immense value on leadership. In fact, he has said, "I look for 3 things in a business: honesty, competence, and a sense of the long term." He believes that good leaders are crucial to the success of a company. Buffett often mentions that he can tell whether a company is well run within just 5 minutes of reading about the CEO. What he looks for are executives who are not just skilled but have integrity. He also loves to invest in companies where the leaders are aligned with shareholders' interests. A leader who owns a significant stake in their company is a strong signal for Buffett. It shows that they are committed to the company's long-term success. One example of this is Buffett's admiration for Bill Gates at Microsoft. Buffett has said that Gates's ability to adapt and lead through changing tech landscapes is one of the reasons he invested in Microsoft. A study by McKinsey & Company found that strong leadership can directly boost a company's profitability by up to 30%. Buffett's ability to gauge a leader's potential quickly is a big reason why he's so successful at picking winners. Chapter 5. The Moat Test. Buffett's secret weapon for picking winners. Warren Buffett's favorite investment idea is the concept of a moat. A moat is a company's competitive advantage, something that protects it from its competitors. The wider the moat, the harder it is for competitors to steal market share. Buffett loves businesses with deep moats because they can maintain high profits even when times get tough. For example, Coca-Cola's brand is its moat. It's one of the most recognizable brands in the world, making it nearly impossible for new competitors to challenge its dominance. Research by Harvard Business Review shows that companies with a strong moat tend to generate higher profits and experience less volatility. Buffett also emphasizes that moats don't have to be physical. Intellectual property, such as patents, can also serve as a moat. Apple's ecosystem of devices, software, and services is a perfect example of this. A company with a strong moat can weather competitive storms and maintain steady cash flow. For Buffett, investing in companies with deep moats is like having a long-term insurance policy. They are protected from market disruption, allowing them to continue delivering value over time. Chapter 6. The Long Road. Why patience is Buffett's greatest tool. Buffett's investing philosophy revolves around the power of patience. He's not in it for a quick profit. Instead, he buys stocks with the intention of holding them for decades. "Our favorite holding period is forever," he has said. This long-term approach is what allows him to ride out market fluctuations without losing sleep. He focuses on businesses that have the ability to generate steady cash flow over many years. A good example of this is his investment in See's Candies. He bought the company in 1972 and it continues to be one of his most profitable investments. According to a study by the National Bureau of Economic Research, long-term investors typically see better returns than those who buy and sell based on short-term trends. Buffett believes that by holding onto companies that have strong fundamentals, investors can take advantage of compounding growth. This requires immense patience, but the rewards are worth it. His long-term mindset also lets him avoid the stress and anxiety that comes with trying to time the market. Instead of focusing on daily price movements, he invests in businesses that will succeed over many decades. This calm, steady approach is one of the key reasons why Buffett is one of the richest people in the world. If you found these strategies helpful, don't forget to hit that subscribe button for more insider tips, and turn on notifications to stay updated with the latest videos.